So silver recently spiked past $114 an ounce before pulling back, and the internet pretty much lost its mind. All the usual financial news outlets are talking about inflation and safe haven demand, and sure, that's part of it, but they're all missing the real story. This isn't just another price rally. What we're seeing is a warning shot. The real story is a massive supply crisis that's been building behind the scenes. It's a fundamental break between the paper price of silver you see on your screen and the struggle to get your hands on the actual physical metal. This is the evidence that the physical market is starting to crack under the pressure. On the surface, things look volatile but familiar. The price hit a historic peak of over $121 in January before settling to where it is now, around the $93 mark. But when you look inside the vaults of the COMEX, the main exchange for silver futures, a completely different and frankly alarming picture emerges. The lifeblood of the COMEX is its inventory, and the most important part of that inventory is called registered silver. That's the metal that's officially ready and available to be delivered to someone who owns a futures contract. It's the physical supply that's supposed to back the entire paper market, and it's vanishing at an incredible rate. The data we've been tracking is stark. As of late February 2026, the amount of registered silver in COMEX vaults has dropped to around 88 million ounces. To put that in perspective, back in April of 2020, there were 240 million ounces. That's a collapse of nearly 64% over the long term. This isn't a slow leak. It's a flood out of the vaults. In one single week in January 2026, a massive 33.45 million ounces were pulled out. That was over a quarter of the entire registered inventory at the time, gone in just 7 days. This isn't some wild guess. It's just arithmetic. This brings us to the core of the problem, the huge growing gap between the paper promises being traded and the actual metal available to back them up. Right now, the paper leverage, the ratio of paper claims to physical silver, is over 6-to-1. Some estimates even put it at 6.5 paper claims for every single ounce of real, deliverable silver. Think of it like a theater with 600 ticket holders but only 100 seats. Everything stays calm as long as everyone just trades their tickets and assumes a seat is there for them. But what happens when people actually start showing up and demanding to sit down? That's what's starting to happen. This isn't just about traders anymore. We're talking about a structural problem where big industrial and institutional players might be losing faith in the paper system. For decades, the market has run on the assumption that most contracts would just be settled for cash, but the data suggests a major shift is happening from trading paper to demanding physical metal, and that's putting a strain on a system that was never built for this kind of physical demand. This crisis isn't just happening in New York. What's going on in Asia is maybe the biggest red flag of all. We're seeing what some are calling the Great Divorce of 2026, a split between the paper price in the West and the physical price in the East. The key indicator is the Shanghai silver premium. For most of history, silver prices in New York, London, and Shanghai have traded closely together, but that's changed. Recently, the premium for physical silver in Shanghai has surged, at times hitting $9 or even more than $10 per ounce above London prices. A sustained premium like that is a flashing red light. It signals a genuine, severe shortage of physical metal in Asia. Buyers in China are willing to pay way more to get their hands on real silver now instead of trusting a paper contract for later. It's the clearest sign you can get that the market is shifting from speculation to physical accumulation. This is being driven by real-world policy. On January 1, 2026, China expanded its export controls, officially treating silver as a strategic material needed for its own energy and defense industries. This has started to fragment the global market, trapping supply in the East and stopping it from flowing back to refill the emptying vaults in London and New York. So what's causing this unprecedented drain? It's a perfect storm of powerful forces. First, as we've seen, major world powers are now treating silver as a strategic national asset. In 2025, the United States officially added silver to its list of critical minerals for the first time ever, a list that guides federal strategy. This isn't just a financial game anymore. It's a global competition for a finite resource. Second, industrial demand isn't just strong. It's accelerating. The green energy revolution is literally built with silver. It's in every solar panel and every electric vehicle. Beyond that, it's essential for AI data centers, 5 grams tech, and modern electronics. The catch is, these industrial giants have always relied on the exchanges for a just-in-time supply. If they start to get worried and begin building their own stockpiles, it could trigger the final phase of this physical squeeze. And finally, the futures market itself is screaming for metal. For much of this year, silver has been in backwardation, a rare situation where the price for immediate delivery is higher than the price for future delivery. This isn't normal. It's a condition seen during times of extreme market stress like the 1980 price peak, the 2011 spike, and the 2020 supply disruptions. It's the market's way of saying it wants metal now, not later. Now, skeptics will argue that the COMEX can never truly fail. They'll say the exchange can just change the rules, raise margin requirements to scare off speculators, or ultimately force everyone to settle in cash, and they aren't totally wrong. The exchange has in fact raised margin requirements, which caused some of the price pullbacks we've seen. But here's what that argument misses. Those are just temporary patches on a deep structural problem. Forcing a cash settlement isn't a solution. It's an admission of default. It would be openly admitting that the paper promises can't be honored with the metal they represent. An event like that would shatter confidence in the paper market for good and likely send the price of physical silver into its own orbit. So, are we watching the beginning of a real physical silver squeeze? While nobody can predict the exact moment something might break, the evidence is overwhelming. The market is running its sixth straight year of a structural supply deficit, where demand has outpaced new mine supply, and it's finally catching up. The vaults are draining at an unsustainable pace, and a huge gap has opened between the paper and physical markets. The pressure is on, and the question is no longer if something will give, but when. We are in the middle of a perfect storm for silver. Record demand, high prices, backwardation, and vaults being emptied at a historic rate. It's a convergence of sovereign buying, relentless industrial demand, and a growing crisis of confidence in the paper markets. The price spike to $114 wasn't the end of the story. It was a tremor, a warning shot from a market under extreme physical duress. The real story isn't the price on your screen. It's the scramble for physical metal happening behind the curtain, and this story is far from over. If you want to stay on top of this investigation and see what the data is telling us each week, make sure you subscribe and hit the bell for notifications. The widening gap between paper promises and physical reality is becoming one of the most important stories in finance, and you'll want to be informed. Let me know what you think. In the comments, are we on the verge of a COMEX default?